All right, so let's begin. Insurance and investments are two things that people focus on their earlier years, but after retirement, both tend to take a back seat. On the Money Show today, we will analyze how you can plan your investments and insurance post-retirement. So for that, let's welcome on board Harsh Roongta, founder, Fee Only Investment Advisors LLP. Harsh, good evening and welcome to the show. So we all know the importance of retirement planning, and we all know why it needs to be the first financial goal whenever you start your investment journey. A lot of time, people tend to organize and think about the requirement or the financial needs that they might have after retirement. But what usually people miss out is to understand the requirement of insurance coverage, and the type of insurance coverage. Although insurance is something that needs to be in continuity, obviously it's not just post-retirement that you will think about having an insurance cover. It needs to be there lifelong with you. But talking about that stage when you are retired, what goes into planning, which could be an essential planning for your insurance post-retirement? How can you draw a structure for that?
So I think your insurance needs continue, but the type of insurance you need obviously changes. What is the thing that happens on retirement? Your income stops. So I think any insurance that you had to protect the continuity of such income is no longer needed. So you don't need, for example, term insurance, except in the case of, let's say, pension. So we'll keep that out. But you don't normally need term insurance for that. You don't need probably critical illness or accidental disability, because they were there to protect continuity of income. What obviously you continue to need is insurance that will pay the costs of any hospitalization or the costs of any illness other than hospitalization also. And that is very, very essential as you age, because as you age, and given modern technology, what is happening is that our lifespans are increasing, but because we are living longer and longer, the last decade of your life, or even earlier than that, is normally spent, with lots of health problems, which in turn has lots of costs attached, which you have to plan through an appropriate health insurance. And I think the key there is that most people think they will do it once they retire. So let's take the case of a person who's working in an employer, and the employer has given health insurance which they find, say, adequate. So they don't even bother कि retirement के बाद देखा जाएगा. But as you age, you already get some diseases, maybe diabetes, maybe blood pressure, maybe something much more. Please remember, as you age, even if you are super fit, your ability to get new health insurance is very limited. One. Second, even if you do get it, it will come at a very, very high cost. But getting it itself is a problem. So, and plus, typically all of them have waiting periods before certain diseases will be covered. So I think building your own health insurance outside of what your employer gives you is critical. This is something that you ought to have done at least 8-10 years before, so that that minimum 8 years of no claim history is there, so that a claim cannot be denied to you post retirement. Another thing that a lot of people don't know is that when you retire, the employer insurance, the employer group insurance that exists, the insurer is required on your request to give it to you as a regular individual health policy or a family floater health policy on the same terms as what they give it to in the outside world. The big thing is they're required to give it, one. And two, you carry your claim history with you, which means that any waiting periods would have deemed to have been completed. And if you have been in that job for 8 years, then you would have that. Now you would have an individual health policy for which you will need to pay from your pocket, but at least the claim process on that will be much easier because the 8-year history would have been completed. So, to summarize, don't put off health insurance till the last. Make sure you have your own health insurance. Be aware that you can convert your employer's group insurance policy into a policy owned by yourself, including in some cases your aged parents. So if you have a group policy that covers your parents, when you retire, you can convert that into a policy that covers your parents as well. And you imagine somebody is retiring at 58, 60, their parents are likely to be in the 80s, and the importance of health insurance at that age. It is a fundamental right, and many countries governments change on health insurance, and it is becoming increasingly important and electorally, even in elections it is becoming important in India, and going forward it is going to become even more important.
But then just focusing on the point where you mentioned that it will be very difficult for you to buy a health insurance, at that age, or maybe if you get one, you'll be having a waiting period for certain diseases. Talking about the kind of trend that we are seeing in health insurance and the kind of launches, the kind of products that general insurance companies are coming up with, are also in tune with this particular thought that maybe someone wants to buy health insurance when they are about to retire or when they have retired already. So not many, but then there are few products which are specifically aimed for senior citizens. Could you just draw out a structure of those kind of plans which are available, what kind of waiting period they have, for what kind of critical illnesses, and most important, are these plans at this age expensive to buy?
So they would be expensive even if you bought them in advance. So so I don't think the cost will differ. But let us stick to these, quote unquote senior citizen plans, right? That you buy when you have become senior citizen. First, even availability of these senior citizen plans, if you will, and today having some heart problems, having blood pressure, having diabetes is pretty common by the time you reach 60. For them to get even these senior citizen plans is going to be very tough, no matter what the brochures say. That's one. Second, if you look deep into these plans, most of these plans have what are called co-pays, and they're not necessarily wrong, okay? Because for every 100 rupees, they would require that you pay X percentage, let's say 20%. There is a plan that says 50% you will have to pay yourself. So yes, it does give some coverage, but it is it is still tough to get. Plus, it gives only partial coverage. Plus, you will not get a large sum of money. So, for example, for all our clients, we make sure that our clients don't depend only on their employer insurance, even though that might be very generous. But we make sure that they also have fairly decent, and by decent I mean say 50 lakhs or a crore of health insurance, which will pay for hospitalization expenses, by the time they are 40, 50, even though that may not be used, because the premiums are reasonable at that age, plus you get a no claim history by the time you are of retiring age, and getting claims at that age is difficult. And remember, medical inflation is running in double digits, and therefore what 50 lakhs looks big today, in 7 years time that's going to be half. So 50 lakhs is equivalent to 25 lakhs of today's money 7 years hence. It's equal to 12 lakhs of today's money 14 years hence. And medical inflation is probably running at much more than 10%. The figures that I'm giving you are not astronomical. Unfortunately, health insurance premium is a good investment. And I say unfortunately, simply because you would be very fortunate if it is not a good investment for you, that because most people will, in their later years, will use up their health insurance amounts not once, but in over multiple years. So, unfortunately, health insurance is a good investment.
One more point where I want you to help our viewers understand or maybe stress upon, because we're talking about life after retirement and we are talking about the importance of having enough or the right kind of health coverage. Times are changing, you know, now dynamics in a family or the family structure is also changing. A lot of time parents don't have their kids around, kids are abroad or maybe not living with them. This is the time when you have to take care of your health, and obviously having the right kind of health insurance is needed. But apart from that, because we don't have that kind of a culture in India where there are healthcare facilities or communities which are starting up, but then it'll take a long time for them to become very common for everyone. How can one ensure if they are living alone, they are taken care of? This will definitely this has to be more than having a health insurance plan.
Oh, absolutely. I mean, health insurance will only pay for expenses, right? You
Exactly. Yeah.
hope to God it goes completely waste and that you don't have those expenses in the first place. And I think many research has shown that people who are more social, they have a friends, they have connections, whether those connections are family connections, whether those are friends, whether it is the the religious connections that they might have with the particular religion that they belong to. A lot of this research is Western, but it also some of it has been done in India as well. Very clearly, people who are socially well connected, equalizing for all other things, they live longer and they live healthier and longer. And I think that is a critical thing. And coming back to your question about, what kind of community and what kind of facility to live in. So one obviously is you live in a facility that will give you required medical facilities, but one must not forget that the big importance is also it must give you a community. For a lot of people in India, the community is already established. They are living in an area where their friends are there, their family is there, there are support systems that already exist. And for them to sort of shift to a completely different center, which for real estate cost purposes tends to be outside the main cities, tends to be more difficult for people who, because their children have gone overseas and their circle has somehow dwindled, uh, they may also look at these communities because then they will meet like-minded people, and that is as and more probably important than having health insurance or having medical facilities.
Last question to you, and this is the question that I ask you every time whenever we have a discussion on anything related to retirement: maintaining a constant flow of income. This is something that one needs to plan at an earlier stage, but what all needs to cut down in your daily expenses so that you maintain that constant flow and really don't go overboard, and also at the same time continue your investment strategy and just not get scared of equity. That is something that maybe you can have in your portfolio in a smaller amount, but then to beat inflation, that's the asset class one can bank on even after retirement.
So first, I think if you have planned well, then you ought not to cut down your expense. The whole idea is to live retired life fully. Okay, so if you have planned well, clearly you have not planned well if you have to cut down on your expenses. One. Second, one must remember that if you have planned, let's say that you will probably live till 85 and you have planned your resources like that, keep on upping it. The science behind longevity and better health spans is expanding so fast. Every day there are new developments that you are probably going to live much longer than you expected, and hopefully you will also live much healthier. So at least financially you need to be prepared. In any case, retired lives are now 25, 30 years. That kind of a period, inflation can ravage your investment strategy if you have not prepared for it. And you have asked me this question many times. I'm going to give you the same answer. have equity and have it in a self-balancing form. Look at, and I think later on in the program, you're talking about equity saving program. What a lovely little product that is for a retired person to get equity or a little bit of equity, that too in a automatically self-balancing form. So whether equity saving, whether balanced funds, whether balanced advantage funds, I think look at equity because you are, God willing, going to live a long, long time and live it very, very healthily. So you need to plan for it.
Can one also try direct equity? Can one also have a portfolio of stocks?
So I would not advocate it. I mean, especially for people who have a lot of money, because in my opinion, lots of money and lots of time equals to disaster. And you have the SEBI report that tells you why it is a disaster.
All right, so these are the things that one needs to really keep in mind after retirement, and what's going to happen after retirement, at least financially, you need to plan right now. Thank you so much, Harsh, for being on the show and helping our viewers with that. And on that note, let's take a quick break, and post that, we are going to talk about a very interesting hybrid category where investors can invest and have a balanced approach towards their entire portfolio after this break.